is nationwide, so it covers all the states. So we will issue NASBA CPE credit. Okay, so yes, I see questions populating and then disappearing. So bear with me. Okay, let me, a polling question has launched, and what we will do is we will just use that polling question as a test to make sure that you're able to access it. Click the radio button to the left of the answer choice. It's not going to count towards attendance, but we are, like I said, we're going to start right now. So this webinar is free, so no payment information was collected at time of registration. So no need to worry about that. The polling questions stay up for several minutes. So you'll have plenty of time to answer them. You do kind of have to be paying attention on the screen, as there is no bells and whistles when the polling questions do launch. But you do have to answer them for attendance. Today's credit is in ethics. So this is 2 ethics credits. If you don't see polling questions, you might have a pop-up blocker enabled. If you do have a pop-up, now the polling question has closed. So if you didn't see it and you were on the screen, you may have a pop-up blocker enabled. That has to be disabled, or else you're not going to see the polling questions throughout the presentation. I bet Lissa is also in North Carolina, so you guys are waiting patiently for the storm. So if you have to hit the poll up top to see the polling question, then like I said, most likely you have some sort of blocker enabled and it's not allowing the polling question to pop up on the screen. If you're on a mobile device and you're full screen, sometimes the polling questions, you can't see them. All right. We are starting, I'm told, in 30 seconds. So once we do, we will bring John back on the screen to kick everything off, and we'll get into our prepare due diligence with Jason Daughtry today. Yes, Jennifer, tell your friend to go to taxpracticepro.com, click webinar. Oh, you're right. So let me, you're right. She can't register directly on the website. I will fix that. And she can go right to the website to taxpracticepro.com and register. Bear with me. I'm so sorry. All right. Last announcement. If you do go to taxpracticepro.com, you can click webinars and then click and then register, and you can come right in. So I'm going to bring John back on the screen and hand it over to him and Jason, and we're going to get started right now. Take it away, John.
Oh, I don't see my face yet. Everyone, welcome to, I don't see my face launching, Nicole. Okay. Hey, welcome to Tax Preparer Due Diligence, presented by our friend Jason Daughtry, EA of Affirmative Tax Educators. I have to give you just a quick commercial. So how are we able, but first I want to apologize. The program, we're having some sort of trouble with the YouTube stream. I can see it. It's not populating into YouTube. I wonder if it's going to run at a delay. I don't know. But for those, it'll be available for replay, so folks should be able to watch this. How are we able to do this for free? Tax Practice Pro is a continuing education provider. We operate primarily on a subscription-based plan. We offer 16 to 20 credits a month, 10 months out of the year. In addition to that, we include an annual monthly international class, a monthly and an annual AFSP program and an annual free ethics program, plus a federal tax update and several state updates at the end of the year. Again, for $52 a month. Normally, there's a $200 startup fee. That's going to be half off if you right now go to that QR code today or tomorrow and enter the discount code. The last chance offer is right here, 50% off. Use offer code last chance 50. All right. We run on a monthly theme. This month was things I meant to learn. By the way, in addition to the 16 to 20 credits a month, we do have about 300 credits of education available for self-study. We are licensed with the Internal Revenue Service, California CTEC, Texas Board of Accountancy, and NASBA. And these are our monthly topics for this year, for 2026. I think it's already been mentioned by Nicole. To earn credits, there will be 8 polling questions. You need to answer 6. You don't need to get them correctly. We hope that you do. The polling questions aren't announced. Jason won't stop for them. They will populate in the background. Just answer them. If you're watching this not on a computer, but on a handheld device or a tablet, you may need to move your cursor a little bit to the left of the radio button to get it to register your question. I'm sorry, to register your answer. Give us, for something this large, give us about 10 days. You'll get a link to the certificate in the email address that you provided to us when you registered. If you would like to ask a question, please don't put it in the chat. Click the Q&A tab on the right-hand side and enter your question. If you already see your question in there, there's an upvote button. Click the upvote button. It'll move the question further up in the list, and we'll know more people are interested in it, and B, we may get to it more quickly because it's higher up on the list. And then a copy of this presentation and a few other things is prepared. Click the handouts tab, and you'll be able to download those PDFs. And if you have trouble with that, email, don't blow up the chat, email the office, Nicole at taxpracticepro.com, John at taxpracticepro.com, and we will happily get that over to you in an email, no problem. Hey, Nicole, can you advance that for me? I can't get it to advance. Fabulous. All right. Have her turn it over to Jason. Alexa, are we connected to the internet?
Alrighty, for our self-study and on-demand participants, there will be a quiz located in the handouts icon next to the volume button on the self-study video. You must watch at least 100 minutes of this program to receive CE. You must watch at least 50 minutes of this program to receive 1 CE, and you must take and pass the quiz at the end of watching the program.
Alexa, are we connected to the internet?
Alrighty, thank you so much, and we're going to pass it over to Jason.
Yes, all your devices are online and connected.
Hey everyone, how are you? John, can you hear me?
I'm doing great.
Can I hear some type of talking in the background?
I can hear you, Jason.
Okay, everything's good. Everything's good to go.
It is on my end. I think so.
Okay. All right. So first of all, I want to thank everyone for showing up. We have a very, 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 very large audience today, somewhere upward of 2,500 to 3,000, something like that. So a lot of moving parts, a lot of things that have been going on, little bit of technical difficulties, but we got it all worked out now, and we're going to get through this. Everyone's going to be due diligence experts when we're done this, and we're all going to go and hunker down for this weather. For I guess most of us in the country will probably be facing this weekend. Um, my name is Jason Daughtry. For those that don't know me, I get around a lot on social media, so I go back and forth with a lot of people on social media. We do a lot of debating and talking, and we'll do that today. We'll have a lot of fun, hopefully, and we'll get some knowledge, some education, and we'll all be better for it. The profession will be better for it, and us as professionals will be better for it. Before I start, I do want to give a couple of shout outs. I want to say Kayla Perry, and I'm gonna butcher the last name for a second, Pam Schneekloff. Both recently passed their EA exams. Pam actually passed this morning around 8:30 this morning. I saw her post on Facebook and said she passed. And for both of them, I'd like to say congratulations. I'm very happy for you. I'm always happy when I see people advance, not just for the EA, but when they advance in anything that they're trying to do. I'm very happy for people that do that. So I just wanted to give them a quick shout out. I want to kind of start this off with first explaining the audience that we have today. Like I said, it's upward of 2,500, and how we're going to move forward with this presentation. I'll start with describing how me and my wife, we're in business together. I'll describe our business structure so you can kind of see why I will be instructing the way I'm instructing. Me and my wife, we actually own 3 separate companies. The first company is Affirmative Tax Relief. That is a representation firm. That's all we do in Affirmative Tax Relief is representation. That is either representing taxpayers before the IRS and state taxing authorities, or tax preparers and before the IRS or state taxing authorities. 100% representation. Then we have the income tax place, which is technically my wife's practice. That is solely tax preparation. That's where we're recording from today. Both of these practices are in New Jersey. Affirmative Tax Relief is in Mays Landing, New Jersey. The income tax place is in Galloway, New Jersey, right outside of Atlantic City. And that, like I said, the income tax place is solely tax preparation. We do have 4 employees. Some are fairly new. Actually, 2 will be this year, will be their first year preparing. So they're all preparing returns. They're also on this webinar watching. My wife is also watching, which is why I have my tie on. She actually dressed me today. And our receptionist is also watching here at the income tax place. And then we have our third practice is Affirmative Tax Educators, which is our continuing education CE provider. And that is our third company. I'm bringing this up because we have different aspects covered here. We have some of our employees watching. We have some that are experienced, some that are not. Also from my community online, we have some practitioners that are 30 years in the game, some that are brand new, and everything in between. So when you're having such a diverse, oh, and I'm sorry, we also have some IRS revenue agents on the webinar also that we happen to know personally. So they're tuning in also. I say all that to say that we have a very diverse audience. So some stuff may seem basic to some, or it may not seem basic to some. I don't want to lose anybody, so I may try to break certain things down. Understand that it's not only about you. Maybe you've been in the game 30 years, 40 years, and you understand, for example, you understand what IRC means. But I may have to break it down and say Internal Revenue Code, because some may not understand what IRC is. So I wanted to kind of do that. I also wanted to get into a little bit of my own personal housekeeping and discuss a few things. One is, do not view the information you receive today as competing information with other due diligence training or education that you may have had. You don't want to take this information and compare it and compete it against other. Use it as an accompanying information. Take this information, add it to what you already know or what you've heard. Now, if something's just totally contradictive, then yes, ask your questions, bring it up, let's resolve the issue. But you don't want to be confused. This guy said that guy said this, and now I'm confused. Because you know, you want to put it all together. Also, we will not be discussing individual cases. You know, we you know, with 2,500 plus people, we don't really have the time to. I got a client who did this, and I got a client whose mom lived in Mexico and came over here, and can they do head of household? We don't want to get into all that. Also, we don't want to get into debating tax law as a, you know, other than due diligence. So, you know, we're not going to talk about no tax on tips and no tax on overtime and QBI deduction and depreciation. We're not going to discuss any of that. Only thing we're going to try to focus on is due diligence under 6695G. And lastly, from a housekeeping standpoint, moving forward, I'm going to try to establish today that the IRS personnel is not the authority. Now, keep in mind, I said there's IRS revenue agents on this webinar, and they are not going to disagree with that because they are the first to agree that they are not the authority. Jason Daughtry is not the authority. John Shealy is not the authority. And the authority is Congress and Treasury regulations and Internal Revenue Code and things like that. And I'm going to point out the authority. So when you leave this webinar, you know, you don't have to go out here and say, well, Jason said blah, blah, blah. Technically, Jason's not saying it. Jason's just relaying the message. What Jason is saying is Internal Revenue Code or Treasury regulations or something like that. Now, there will be parts in this webinar that I'm going to say my opinion, you know, or something like this is how we do it in our office. That's not the law. Although I'd like to think my way is the law. Unfortunately, I'm reminded every day by those on Facebook, as well as my wife, that my way is not the law. I will address it. I would say, hey, this is how I do it. It's not the law, but this is how I do it. You're more than welcome to do it that way, but it's not a requirement. When something is a requirement, when it is the law, I will also point that out. I would say this is the law. It's not up for debate. This is what you have to do. This is the law. And that's how we'll do it moving forward. My goal with teaching this class for over 10 years now is to try to clear up confusion. There's a lot of confusion with due diligence. And I'm hoping that I can clear that up for a lot of the people or everybody in a fairy tale world, everybody today. We will take questions as we go. We're going to take the questions segment by segment. So once we get through a segment, if you have a question on that segment, you would ask that question at that point. If we don't get to it, we'll have more time for all questions that we didn't get near the end. But I do want to knock out segment by segment and kind of answer your questions as we go along. All right. So we're talking prepare a due diligence. One more thing I did want to say. I do have some prepare a due diligence audits coming up this week, weather permitting, and those practitioners that I'm representing are also on this webinar. So this is kind of a training or in preparation for some upcoming due diligence webinar, due diligence audits that I'm representing preparers in. One is Monday in Shreveport, Louisiana, and the other one is Thursday in Columbus, Ohio. So there's a little bit of training in preparation of a due diligence audit going on today also. Anyway, I am clicking, but it's not changing. Can I get some help here? Oh, there we go. All right, so today's learning objectives, we are going to discuss what is not due diligence and the thought process. One thing that I find that is that is confusing quite a bit is people say, "Oh, I know I do my due diligence," and when I say, "Well, what is due diligence?" A lot of time we get a bunch of different answers. So I figured we'd start this off by discussing what is not due diligence and the thought process. And then we will get into types of preparer penalties and where due diligence fits in with that. We'll discuss the Office of Professional Responsibility. Um, Within the Office of Professional Responsibility, there's a lot of new things that are happening. I'll share those new things. Um, the OPR is not new, but how the IRS is enforcing certain things is kind of new. That's one benefit of representing so many preparers and so many due diligence audits. You can kind of stay on top of the changes when things happen. Keep in mind, the law itself is not changing. It's just how the IRS enforces the law is changing. And we'll get into that. Then we'll get into the meat and potatoes of the webinar. The 4 due diligence requirements. We'll also get into the consequences of not meeting the due diligence requirements, and then bulletproof your office and procedures. One thing I do want to say, it just popped into my head. I know recently there was an IRS webinar on due diligence last week or so, maybe the week before, about a week ago. I always highly recommend that people take the IRS webinar on due diligence every year. It's free every year. Not from a learning standpoint, because the IRS is not going to tell you anything different other than the law. But there's a couple of reasons why everyone should take that webinar every year. Number one, it gets on record that you did take some type of due diligence education. Also, you can just kind of get it from the IRS's point of view. In addition to taking the IRS webinar, you always want to take other due diligence webinars, such as this one today, or anyone that has experience with due diligence, because you can get it from a practitioner standpoint. The IRS does not have a business to run. They do not prepare tax returns. They do not have a line of people out their door February 10th waiting to get in. The IRS doesn't have a practice. That's what I'm trying to say. So when you take due diligence from someone that actually has a practice, you can kind of see how you can apply the law in a practical standpoint. Leave it up to the IRS. They'll have you sitting here for 3 hours asking questions of your client. I'm not doing that. I have a business to run. I have a family to take care of. I have money to make. I have tax liabilities to reduce, whatever it may be, W-4s to calculate, overtime premium deductions to calculate. I have things to do. I don't have time to sit here and ask our clients a bunch of unnecessary questions like the IRS would want us to. So my job is to do my job efficiently, quickly, thoroughly, and move on so I can service the client. And that's what I want to help everyone here do. With that said, we will proceed. Something's going on with my clicker. There we go. All right, Treasury Regulation 1.6695-2 states the tax return preparer must make reasonable inquiries if a well-informed preparer, knowledgeable in the law, would conclude that the information furnished appears to be incorrect, inconsistent, or incomplete. Again, this is a copy paste from Treasury Regulation 1.6695-2. I highlighted certain words in this statement. These words are what you are trying to focus on in the event of a due diligence audit. Due diligence visits. Sorry, the IRS calls them DDVs, due diligence visits. They go out their way to say they're not audits, but yes, they are audits. But technically, they say they're not. So due diligence visits. we'll break this down. Reasonable inquiries, right? That's pretty much self-explanatory. We want to ask reasonable inquiries. If a well-informed, so well-informed is highlighted. You're trying to let the IRS know in the event of a due diligence visit that you are well-informed and that you are knowledgeable in the law. Okay, this is all important information. When the IRS comes to your office for a due diligence visit, when they leave, they want to know that you are well informed, you are knowledgeable in the law. And then we have the 3I test. I call it the 3 ink test. The IRS calls it the 3I test. I say ink because they all start with I and C. That is incorrect, inconsistent, or incomplete. Basically, when something seems incorrect, inconsistent, or incomplete, we are required to make reasonable inquiries. Okay. When something sounds a little weird, we are required to make reasonable inquiries. Notice in this statement, it says nothing about collecting documentation. Okay. There is no requirement to collect any due diligence documentation. I am not talking about documents, period, like W-2s or things like that. I'm talking about due diligence documentation. And we'll get into that more. In addition to this statement in Treasury Regulation 1.6695-2, I'm trying to click. The next sentence in Treasury Regulation 1.6695-2 says the tax return preparer must also contemporaneously document in the preparer's paper or electronic files any inquiries made and responses to those inquiries. So contemporaneously means at or around the time of tax prep. So my clients that we are having these due diligence audits next week, technically, they can't alter their files today because their due diligence had to be done contemporaneously, meaning last year when their 2024, because those are the returns that are being audited, 2024 tax returns were being prepared. That's when you have to make your notes and documentation and stuff like that. So you're not supposed to come back later and do it. It's just like the mileage log. Technically, we're not supposed to go and recreate a mileage log. It's supposed to be done at or around the time the mileage was accrued. That's how due diligence works, although we know a lot of people do it anyway. John, is this something with my clicker? Is that something I'm doing that's making this not click? All right, well, we're going to keep it moving. All right.
Hey, Jason, I think so. You should be able to advance the slides with the caret above our pictures, and it's not working for you?
Well, I have the whole screen, so let me go back to the carets. Let me see if I can.
Any arrow should work too.
You could also use the arrow if you have a keyboard on your keyboard.
Okay, I'll
there
do
you
that.
Go.
That's better.
Okay, sorry.
No problem. No problem. So, like I said, we're going to start with what is not paid preparer due diligence. Okay. Number one, asking tax law questions is not paid preparer due diligence. What I mean by that is this your child? Are you married? Do you provide over 50% of the upkeep and maintenance of your home for yourself and a dependent? Those are tax law questions, right? The one I just said, do you provide over 50% of the upkeep and maintenance of your home for yourself and your dependent? That's head of household, right? That's a tax law question for head of household. That's not a tax law question for due diligence. Okay, we'll get into what due diligence is, but just random tax questions. Like I said, is this your child? Did your child live with you for more than 6 months? That is not due diligence. I'm stressing this because almost every time I get retained to represent a preparer in a due diligence audit, one of the first questions I ask is, tell me what due diligence is, or do you do your due diligence? And they say yes. And they start talking about all the questions they ask. Well, the questions they ask are typically tax law questions. That is not due diligence. Okay. That's tax law questions, right? You do have to ask those questions, but it's not due diligence. Another thing that is not due diligence is checking IDs, social security cards, etc. That is not due diligence. That is checking for identity, that is checking for social security cards, whatever it may be. That's what that is. It's not paid preparer due diligence. Let me clarify. That is not paid preparer due diligence under 6695G. Okay. In fact, IDs and social security cards are not even a requirement when it comes to due diligence. Collecting IRS audit documentation, such as medical records, support worksheets, leases, things like that, is not due diligence. Okay, that's not due diligence. I'm not saying you're wrong for collecting it. I'm not saying you're right, but what I'm saying is not paid preparer due diligence. Those documents also are not required. We'll get into where that stuff comes in and where the thought that it is required comes from, but it's not due diligence. And knowing or getting to know your client is not due diligence. Again, no one is saying that you shouldn't get to know your client. You most certainly should get to know your clients. What I am saying is it is not due diligence. So just because I know my client, that doesn't mean I asked all these questions, so now I know my client. That does not mean I exercised due diligence. All right. So we will go over the thought process. When it comes to due diligence, we are not proving anything. We are not auditing the client. Due diligence is about determining eligibility for particular tax benefits. We will go over those tax benefits. We are determining eligibility, not proving eligibility. One example that I like to use when we discuss this part here is imagine someone asking, a random person asking, can I claim head of household? Obviously, you're going to need some information. So the questions that you may ask, you asking all the questions, and then once you get your answers, you have determined that based on the answers, yes, you can claim head of household. However, nothing was proven, right? Nothing was proven. It is the IRS's job to audit clients and prove stuff. It is our job to determine tax benefits based on the information provided. So we are not proving. Are you wrong for getting your clients to prove something? If that's what you want to do, but it's not a requirement. Okay. If that's what you want to do, if you want to do the IRS's job for them, that's perfectly fine. If I were you, I would try to get paid from the IRS because it's a lot of work when you're trying to do two jobs as a practitioner and as an IRS revenue agent auditing your clients. That's what you're doing when you're getting them to prove stuff. An example that I use, I know very few practitioners that actually collect a marriage certificate. Again, marriage certificates have nothing to do with due diligence. I'm just trying to give an example. In order to file married filing joint, you need to be married. So all you do is ask them, are you married? That's what most of us do. And they will say yes. We are not required to collect a marriage certificate, right? If you want to collect a marriage certificate, you can, but it's not a requirement. So due diligence works the same way. You ask the question, hey, do you provide over 50% of the upkeep and maintenance for your home, for yourself and a dependent? Oh, yes, you do. You just determined eligibility along with the other eligibility requirements for head of household. But at that point, yes, you determined they're eligible head of household. Are you required to collect proof, a support statement and stuff like that? No, you're not. Can you if you want? Sure, you can if you want, but it's not a requirement. So we'll get more into that. Due diligence thought process is about spotting inconsistency, addressing the inconsistency, and then moving on. That's my job here today, to try to show you how to spot inconsistencies, address inconsistencies, and move on. The reason why I say move on, because I'm talking to 2,500 tax pros right now. So everybody out there knows that ever prepared to return knows that there's a lot to be done during a tax return. Um, there's a lot of we're trying to reduce liabilities. Some people are trying to boost, get legal refunds, not leave money on the table. We might have to do some bookkeeping. We might be adjusting W-4s. We might be explaining tax law. We might be doing married filing joint versus married filing separate analysis. There's a whole bunch of different things, actual versus business expenses, mileage. There's a lot of things for us to do. Due diligence isn't one we should spend a lot of time on, right? So we should spot inconsistencies, address those inconsistencies, and then move on so we can service our clients. Okay, that's what I mean by move on. I don't mean move on but get them out the door. I mean move on so we can leave due diligence alone and start focusing on better serving our clients. That's my goal here today as we move through this webinar. Why all the confusion with due diligence? This is all my opinion from over 10 years of doing this. These are the reasons why I feel there's so much confusion. Number one, IRS employee training. Okay. There is no such thing as a due diligence department at the IRS. All right. It should be. I really think there should be, but there's not. The way the IRS is trained in due diligence is IRS is busy doing other things. Sometime around July or August, they'll go around and they'll say, okay, we're going to start doing this due diligence thing. We need some volunteers. So they'll pull IRS personnel from different areas. So they may be working on trust fund recovery penalties or the offering compromise specialists or whatever, wherever they may be, and they go in and they get training on the credits in head of household filing status. And then they send them out into the field and say, okay, go on out there and see what's going on with these preparers. And that's how this works. So more than likely, if you have some years in tax preparation, in a due diligence audit, more than likely you are going to know more about due diligence than the revenue agent sitting across from you. I'm not saying they're bad people. What I am saying is they have their training. They do not prepare returns though, right? We prepare returns. We see people trying to commit fraud. We see people trying to get one over on us. We see some strange situations. We have experience with all that. So my point is, we are, as practitioners, are better trained in due diligence than 99% of any revenue agents that's going to be sitting across from you. I'm not saying they're not good at their job, because remember, the IRS pulls them from other places. So they could be working payroll tax audits for 30 years and be very good at that, but they don't know the first thing about EIC. Right? Because they're just training for this time of the year to do due diligence visits. So that's one problem, IRS employee training. Another problem is preparers are teaching classes based off of their audit results. Again, if you have IRS coming in here penalizing people for stuff that shouldn't be penalized, and then you have preparers not having representation or not pushing back on those penalties, they're now thinking, hey, this is what the IRS told me, so therefore this is how it is. Let me go share on Facebook the results of my audit and show my friends and my colleagues how it should be done, when the whole time they're really teaching it wrong because the IRS wrongly penalized them. So that's one problem that I see. Preparers are teaching classes based on their audit results when their audit results are not correct. Then, of course, we have Facebook and other social media. That's pretty self-explanatory. Of course, TikTok and things like that. We have a whole bunch of stuff going on out there, social media. And then we have just straight up fear. I'm going to say this. Back in the day, before I started doing this is just conversations that I've had with IRS personnel. There was a time when you had a due diligence visit, the IRS would come in, multiple revenue agents will come into your office and audit all of your clients. So if you have 1,200 returns, they'll audit all 1,200. That was before I got into this. Somewhere around the time I got into this, it was 50 returns. That was around 2014, 2015. They started pulling 50. Then now, at sometime around the pandemic, after the pandemic, they went to 25, which is now they pulled 25 returns. I'm saying all this to say, if the IRS was auditing 1,200 returns, 1,500 returns, 2,000 returns, you can imagine what those penalties were. And there's people from them times that are still sharing their experience. So I've seen people on Facebook saying, oh, I had an audit back in the day and I got $300,000 worth of penalties. Well, that's impossible now because they're only doing 25 returns. Okay. But that fear of $300,000 in penalties, $200,000 in penalties, $100,000 in penalties is causing a lot of confusion out here. So these are the main reasons why I feel there's a lot of confusion. And today we're going to clear up the confusion. Types of prepared penalties. We're going to kind of blow through this. I just want to show everyone how this due diligence fits into other prepared penalties. We have 6694. Okay. Preparers typically have two different code sections. There's multiple code sections, but they're primarily in 6694 and 6695. 6694 is linked to Circular 230, Section 10.22. That's diligence as to accuracy. Okay. Accuracy on a return. 6694 is an understatement of tax due to an unreasonable position. 6694A. 6694B is the same thing, except it's willful and reckless. An example of this, bear with me, we're going to get to due diligence. But an example of this is we had a client who claimed on their client's tax return, they claimed business mileage as well as actual auto expenses. Obviously, you can't do that. They claimed them both. IRS came in and said, you claimed them both because you wanted to get your client a bigger refund. That was willful and that was reckless. We're going to hit you with 6694B penalties. We argued back that it wasn't willful, it wasn't reckless. They were just uneducated and dumb. And long story short, we won. My client was proven to be uneducated and dumb. That's a win. And I'll show you when we discuss these penalties, you'll see how being dumb in this case is better, because being dumb and getting a 6694A penalty is $1,000, where a 6694B penalty is $5,000. So to save $4,000, yes, I will be dumb as opposed to willful and reckless. There's another aspect of A versus B, meaning 6694A and 6694B, and we'll get into that later, and we'll see the severity, but we're going to go through that. So that's 6694A and B. Then we have 6695, okay? That is failure to furnish a copy of your return. That's A. B is failure to sign a return. Sorry, go back. C, failure to furnish identifying number. D, failure to keep a copy or list of returns. E, failure to file certain information returns. And F, negotiating or endorsing a check. In the handout, we have the penalty amounts and all that in here. So we're going to blow through this. Then we get G. So we just went through A, B, C, D, E, F, G. G is 6695G, failure to comply with due diligence requirements. That's where this fits in all of this. 6695G pertains to earned income tax credit, child tax credit, additional child tax credit, other dependent credit. Those three credits, child tax credit, additional child tax credit, other dependent credit, we're going to call them the dependent credits, right? They're all, that's one violation, which is why you'll always see them together. Child tax credit, additional child tax credit, other dependent credit. Collectively, we're going to call them the dependent credits. But that when I say that, that's what I mean. Then we have the American Opportunity Tax Credit, and then we have the filing status of head of household. All this due diligence stuff started with earned income tax credit. Somewhere around 2015, the child tax credit was introduced, or an American Opportunity Tax Credit, and then then the Tax Cut and Jobs Act in 2017 introduced the other dependent credit. So it changes, but all this due diligence stuff is really around 15 years old. And it only applies to these tax benefits. Notice what's not there. Child independent care credit's not there. Lifetime learning credit's not there. QBI deduction's not there. No adoption credit, fuel credit. No other aspect of tax law is covered under 6695G. All that other stuff that I just named and more is covered under 6694A or B. Okay, when we're talking about due diligence, someone says, I have a due diligence audit. You don't have to check your files for your mileage log or anything like that. They're coming for EIC, the dependent credit, American Opportunity Tax Credit, head of household. That's what 6695G due diligence, DDVs, due diligence visits are referencing. Then we have 6700, 6701. I actually have a class on promoter penalties. That's a very, very big deal nowadays, promoter penalties. That's a whole separate class. We're not going to get in that today, but that's a big deal. Then we have the 7000 series, which is fraud. Here's where all this come in. Office of Professional Responsibilities. On the left of the screen is discretionary referral. On the right is mandatory referral. What this means is whenever you get one of these penalties, the revenue agent involved has to make a determination whether to refer you to OPR, the Office of Professional Responsibility. If it's a 6694A or any of the 6695, which, as you can see, includes due diligence, the revenue agent, it's to their discretion whether to refer you to OPR. If it's one of the more severe penalties, which is the 6694B, remember I told you the story where the IRS was saying my client was willful and reckless. We're going to hit you with 6694B. We proved that they were dumb, which moved it back to 6694A, which means it's now at the revenue agent's discretion whether they want to refer them to OPR. If we didn't argue that they was dumb and they was found willful or reckless, then the revenue agent had no choice, but it's mandatory that they refer them to OPR. So that's one thing that you're fighting for in a due diligence audit. It's not just monetary. It's not just your penalties and your fines. It's you don't want a referral to OPR. Now, common question is, what can OPR do? Well, before we get into that, because the next slide shows what OPR can do. What I do want to say is, here's what increases your OPR exposure. Okay, remember, this is due diligence. If I get penalized in due diligence penalty, revenue agent has to make a determination whether to refer me to OPR. Here's what determines that determination. So if the revenue agent feels or believes or thinks, again, this is not concrete, it's subjective, that you may have destroyed or cleaned up files. So my preparers that I'm representing next week, please don't clean up any files, right? If they determine that you've done that, they may say, okay, I can't prove that. I'm just going to refer you to OPR and let OPR handle it. Over explaining or over confessing, aka auditing yourself. One thing I tell people is keep your mouth shut. They're going to come into your office and say, okay, let me see client number 5 on this list. Just bring up client number 5. You don't want to bring up client number 5, but oh, that's Mr. Johnson. He drives Uber. Oh, I've been doing his return for 20 years. Trying to be friendly and over explain. You're going to end up in OPI by doing that. Bring the file up, be quiet, let them do their job. Admitting violations unnecessarily. That's pretty self-explanatory. You don't want to admit any violations that at all. Using tools absent human judgment. This is all fairly new. Using AI, right? There's no crime against using AI to do due diligence. However, what's been happening a lot lately is when the IRS revenue agent feels that you may have used AI and not your human brain, because that's what Congress wants, they'll just refer you to OPR when you get done your if you get penalties. Okay, and it's not just AI; it's software, it's intake sheets, it's questionnaires. I got a long-standing long-running joke on social media how I say tax preparers want to use everything except their human brain to assess information. AI software intake sheets. My rule of thumb, this is just my opinion. Remember, I said I was going to break out law first, my opinion. My opinion is technology, software, intake sheets, AI, all that stuff is fantastic for tax preparation in every aspect of tax preparation except due diligence. Due diligence requires a human brain to assess information. Use all that technology for everything else to calculate QBI and whatever it may be. Use technology for that. When it comes to due diligence, use your human brain. That's what Congress wants. If it's determined that you're not using your human brain, the revenue agent, that increases your OPR exposure. And lastly, not following the instruction of competent representation. Basically, if you hire representation, don't argue with representation in front of the revenue agent because that shows that you are not getting it. If you want to argue with, let's say I'm your representative, you want to argue with me later, that's perfectly fine, but don't argue with your representation in front of the revenue agent because remember, the revenue agent's job, when they leave, they want to make sure that you're able to do this. They don't want to be concerned with that. If they're concerned with that, they'll report you to OPR. Now, what can OPR do? Some of this stuff is fairly new. This is the lighter stuff. Okay, they've always had the right to do it. Congress gives them the right. They just never really exercised this right until recently, till now. So OPR can impose ethics CE. They can say, hey, let me back up a little. Let me show you. Let me explain what's happening here. You had a due diligence audit. You got some penalties, right? Let's say the penalties is $10,000. You can get a $10,000 penalty with no referral to OPR or a $10,000 penalty with a referral to OPR. We're talking about with a referral to OPR. Okay, so I'm trying to say it's not just about the $10,000. It's not just about the money. There's other things during due diligence audits that you can be hit with other than money. Here's the consequences. Referral to OPR, they could say, okay, we want you to take ethics CE. We're going to make that a requirement. I'm not just talking about any ethics that we're already required, but additional ethics CE. They may require due diligence training. They may restrict preparation of certain returns. I've actually never seen this one, but they may say you can't do any head of household returns. They may do something like that, or no Schedule Cs, something like that. Monitoring. This is a very important topic here, monitoring. What that means is, I'll give you an example. I started this off by saying me and my wife, we own a couple of practice. We own this practice. And my wife is an enrolled agent. I'm also an enrolled agent. Let's just say I was audited for due diligence and I got a referral to OPR and the OPR said, you know what, you're so horrible, Jason. You're the worst tax preparer we ever met. We're going to shut you down. What do you think I'm going to do then? What's going to happen realistically is my wife is just going to start preparing the returns. I still got mortgage to pay, right? My wife is still going to prepare those returns. She's just going to use her PTIN and prepare the returns, take my clients and she prepared them. Well, the IRS knows that. And what monitoring is not only are they monitoring me, right? I just got fined and I can't prepare returns, but they're also monitoring my clients. They're following my clients. So in 2024, they went to Jason Daughtry in 2025, where are they going to go? Let's see what's happening in 2025. So in 2025, if Lisa Daughtry is now preparing that return and it's the same type of stuff, now Lisa's going to get audited. This is why due diligence is important for all of us. It hurts my soul when I see on social media where people say, oh, well, I don't do that many EICs, so I don't have nothing to worry about. Yes, you do. Because if I'm a mess and I get caught and I'm doing something wrong and I get shut down, my client is going to go somewhere else and they may come to you. And when they go to you, now the IRS is monitoring them and that brings you involved. That brings you in. It's almost like my father told me, be careful who you sleep with. You are sleeping with the past partners of every woman you sleep with. That's kind of how tax preparation is. A new person comes to you today, you don't know what their past preparer been through and if the IRS is now monitoring them. So that's a big thing that the IRS is doing. And then the IRS has always done treatments. I put treatments in quotes because I wanted to explain. I explained this on social media before. What treatments are corrective programs. It's basically the IRS treating a practitioner. The example I can give for that is if I have an illness, the IRS views that a preparer who can't do due diligence or other violations have an illness. The IRS is not trying to be punitive. They are not trying to punish. They are trying to correct. They are trying to treat it. Our job as practitioners is to say, I'm cured. Stop the treatments. I don't need the treatments no more, right? Treatments could be IRS letters. It could be more due diligence visits. It could be some of this stuff on the screen, imposed ethics. It could be any one of the it could be monetary penalties. It could be all of that. Our job as practitioners, and if you're representing a practitioner, is to show, hey, we're cured. We don't need treatments anymore. Leave us alone. Go find someone else that's sick and inject them with your ethics CE and your requirement to do due diligence and things like that. So these are some of the things that OPR can do. The more severe things, of course, they can censor you, suspension from practice, disbarment, monetary penalties, public disclosure, or disciplinary action. All right. So now we get into the meat and potatoes. I wanted to kind of introduce that so we can see where we're going with due diligence, how it fits in the whole grand scheme of things. This part here is probably what most people tuned in for. Before we move on to this, I do want to take any questions. I can't see the Q&A. I don't want to mess this up and try to find it. But if there's any questions about OPR, prepare penalties, or anything that we discussed so far, I'd like to answer those questions now. If there's any questions pertaining to due diligence, for due diligence requirements and stuff like that, I'll answer them coming up. Are there any questions now, Nicole?
I am looking through the Q&A, looking specifically at due diligent questions. I do see we have due diligence on, hang on. So I apologize. I see the 4 due diligence requirements on the screen. Where this is our last slide before we advance.
Right. This is the first slide. So the last slide was OPR. So
I'm sorry. So I'm looking for OPR questions. So a lot of these are due diligent questions. I don't see anything specifically related to OPR questions. They're mostly due diligence. So I say let's continue. And if I see it, I will pop it up, but I don't see any.
Got it. And anybody listening, remember, we're going to have time for questions at the end also if we miss anything, but that's how we'll do it section by section. So when it comes to due diligence, there are 4 requirements. Each requirement must be made on its own accord, meaning that just because you did something in requirement number 1, if it comes up again in, let's say, requirement number 3, you must ask the same question in requirement number 3. Each requirement stands on its own. I've had plenty of due diligence audit where people said they did their due diligence because they completed the 8867. Well, that is not due diligence. That is just one requirement. Form 8867. It's pretty self-explanatory. In the handout, there's a copy of a Form 8867. You can always Google Form 8867. It covers EIC, the dependent credits, American Opportunity Tax Credit, and head of household. Again, recognize what's not there. I had on the IRS website, it's actually changed now. I used to have it in the slides until they changed it. They just changed it about a month ago. But the IRS website had lifetime learning credit on here. I believe it's changed. And that was incorrect. Paid preparer due diligence only applies to these particular
I
tax.
know, I'm gonna do something here. So I'm gonna set some.
Hey, Nicole. Hey, Nicole.
I'm so sorry.
Your microphone's on. Okay, I think that's it. All right, so it covers these particular tax benefits. Must be filed with tax return or amended return, either electronically with the return or amended return, or by mail with the mail return or mailed amended return. If you are the paid preparer but not required to sign the return, provide the signing return preparer the completed form in either electronic or paper format. I want to discuss line 5. Like I said, there's more in the handout. The 8867 is in the handout. I want to discuss line 5. There's a lot of questions about line 5 that I get. This is the point where I'm going to say what we do in our office. Okay. We do not collect any due diligence documentation. What I mean by due diligence documentation is, I mean, school records, medical records, leases, things like that. None of that is a requirement. Utility bills and all that is not a requirement. Driver's license, social security cards is not a requirement, not for due diligence. So in our office, this line is always left blank. The line on the 8867 actually says, list those documents provided by taxpayer, if any, that you relied on. I highlighted the word relied because it means you relied on. For example, in the state of New Jersey, that you get an 18% tax credit for the rent you pay. So renters can get an 18% of the rent that you pay, you can get a tax credit on the New Jersey return. So for that reason, there's plenty of people that will give us a lease. They'll give us a lease. This is our rent. We don't ask for it, but they just give us the lease. This is what I pay in rent. This is my lease. I collected a lease in this example. However, I did not rely on that lease to determine EIC, the dependent credits, American Opportunity Tax Credit, or head of household filing status. I'm relying on that lease for the 18% New Jersey renters credit. Okay. So on line 5 of the 8867, you are listing documents that you relied on to determine eligibility for EIC, the dependent credits, American Opportunity Tax Credit, or head of household filing status, not identity. There's some people that'll put driver's license on this line. You use the driver's license to determine identity, not EIC, head of household, the dependent credits, or American Opportunity Tax Credit. You only put documents, if any. The words if any is on the 8867, showing that it's not a requirement. They're saying if you decided to collect documents and you relied on those documents to determine EIC, the dependent credits, American Opportunity Tax Credit, or head of household filing status, then you would put it here. I'm intentionally being repeating that because I'm trying to make a point. If I have water bottle on that line, what I'm saying is I relied on this water bottle to determine EIC, the dependent credits, American Opportunity Tax Credit, or had a household filing status. Okay. My point is Social Security cards, IDs, utility bills, leases, none of that is a requirement. If you're saying that you relied on it for those tax benefits, then you just made it a requirement. You made it on line 5. So I already know, probably in the Q&A or at the end of this, somebody's going to ask, well, what documents do you recommend that we collect? I recommend you don't collect any for due diligence. That's what we do in our office. However, you're not wrong if you collect documents. Remember what I said in the beginning, to be married, you have to be married. Well, I don't collect a marriage certificate. Are you wrong if you collect a marriage certificate? No. If that's what you want to do, then do it. But it's not a requirement. This is very important because in the event of a due diligence visit, remember how I said the IRS is trained. There's been plenty of times me and my wife have been in audits. And I bring my wife up because my wife always, I always tell this story how we was in Florida one time at an audit, and the revenue agent said that my client, the preparer, should have had a written agreement in their files stating that there was an agreement that this single mom would claim, this single father would claim the child as a dependent. The revenue agent said, so you should have had a written agreement in the files. I had to say, no, revenue agent. Treasury Regulation 1.6695-2 does not state that. A written agreement is not a requirement. The revenue agent said, well, it would have been better. And my wife said, well, and I always say this joke, my wife said, well, collecting DNA samples would have been better too, but it's not a requirement. Right. So my point is, the IRS may tell you something, you should have had something. That doesn't make it a requirement. And we as practitioners, if you don't have representation, shame on you, but it's your right not to have representation. But if you don't have representation, or if you are representing somebody, you need to raise your hand. You need to stand up and speak up and say, no, that Social Security card is not a requirement. I get it. I agree with you. Maybe it would have been better if I had the least, but it's not a requirement. So you cannot penalize me $650 for something that's not a requirement. So that's what line 5 is about. I can guarantee you in this office, if we look at every one of these 8867s, everyone in our office, every line 5 will be blank because we do not rely on documentation for due diligence. So we did not rely on any documentation. So there's nothing for us to list. Now, I'm sure somebody's going to say, well, my software makes us put something there. If your software makes you put a document on that line, then you need new software because that software is telling you something to do something that's not a requirement. If you need to put an entry, there has to be a way to put NA not applicable or refer to notes or something like that. We use Drake. We can click a button and say did not rely on the documents made notes to file. Our notes to file is what we will have. So line 5 is blank. If you decide to collect documentation and rely on that documentation, not just collect documents. Just collecting documents does not make a requirement for due diligence. If you collect the documentation and rely on those documents to determine the eligibility for those tax benefits, then you would put that on line 5. We don't do that, so our line 5 is blank. If there's questions for that, please put them in the Q&A. We'll answer at the end of this section. We'll answer these questions for this. You can put them in the Q&A. That is the 8867. That's requirement number 1. Requirement number 2 is compute the credits. Nobody gets penalized on this because everybody uses software nowadays. Our software will compute the credits. That's perfectly fine. As long as we have those calculations, that is a requirement. When it comes to computing credits, we complete the appropriate worksheets to compute each applicable credit, such as those found in the instructions on Form 1040 or 8863. Complete the computations using your own similar worksheets and make sure to keep records showing what information you used and how you made the computations. Now, in our software is perfectly fine for this. You don't have to print this out and keep, we're talking about the 8812 and stuff like that, the EIC calculation. Our software doing this is perfectly fine. Nothing wrong with that. That's why nobody gets penalized on this part. In fact, I've never even seen the IRS collect this, but if they do, you can just print it out. It's fine. Not an issue. The computation of the credits must be based on information provided by the taxpayer to the practitioner or otherwise reasonably obtained or known by the return preparer. That is requirement number 2. Requirement number 3 is the knowledge requirement. 90% of all due diligence penalties come from this requirement here. This is the knowledge requirement. This is all about notes, okay? Knowledge requirement. Must not know or have reason to know that any information used in determining the taxpayer's eligibility to file as head of household or in determining the eligibility for the amount of any credit claimed on a tax return or claim or refund is incorrect. So you must not know or have reason to know. This example is from Treasury Regulation 1.6695-2. And I'm gonna break this down for a split second. Remember, we have varying levels of education on this webinar. We have some people that never prepared a return. So those that are more experienced, please bear with me. I'm gonna explain the Treasury Regulation. IRC, the Internal Revenue Code, Congress writes that. Congress writes tax law, okay? Due diligence is under IRC 6695G. So 6695 is Congress's writing. That is the law. Treasury regulations is the IRS's interpretation of the law because the IRS is the muscle of the IRS. They enforce the law, okay? So the IRS has an interpretation. The IRS's interpretation isn't necessarily right, which is why we have tax court, or should I say, we don't necessarily have to agree with the IRS's interpretation. That's why we have tax court. But if the IRS's interpretation suits our clients, ourselves, then I'll roll with it. If the IRS says the sky is red, if I said the sky is red, then I'm going to agree with the IRS. That's fine. We'll roll with that, whatever, right? So the Treasury regulation is the IRS's interpretation. So if we follow the IRS's interpretation, we're okay. Whether the IRS is right or wrong is really irrelevant. This is their interpretation. I'm okay with going with their interpretation. When you try to penalize me, I will revert to your interpretation. And if the person, the revenue agent sitting at my desk is going against the IRS's Treasury regulation, then I can now bring that up in our argument. So this example is directly from the Treasury regulations. Ironically, it's the same scenario, similar, that I had myself. I was 22. I met my kid's mother. She was older than me. She had older kids. My 2 daughters were aged 10 and 11, just like in this example, when I was 22. Okay, right? So I'm gonna read this. This is copy paste from Treasury regulation. This is not Jason saying this. Okay, this is the Treasury regulations. In 2018, Q, a 22-year-old taxpayer, engages Preparer C to prepare Q's 2017 federal income tax return. Q completes Preparer C's standard intake questionnaire and states that Q has never been married and has 2 sons, ages 10 and 11. Based on the intake sheet and other information that Q provides, including information that shows that the boys lived with Q throughout 2017, Preparer C believes that Q may be eligible to claim each boy as a qualifying child in purposes of the EIC and the CTC. However, Q provides no information to Prepare C, and Prepare C does not have any information from any sources to verify the relationship between Q and the boys. To meet the knowledge requirement of this section, Prepare C must make reasonable inquiries to determine whether each boy is qualifying child of Q for purposes of the EIC and the CTC, including reasonable inquiries to verify Q's relationship to the boys, and Prepare C must contemporaneously document these inquiries and their responses. That's a lot of writing, right? One thing I do want to point out, the word verify. When Treasury regulation says we must verify, understand that under Treasury regulation 1.6695-2, verify does not mean prove. Verify means make reasonable inquiries. Okay, that's what verify means in every example under the Treasury regulations 1.6695-2. So to verify information means to make reasonable inquiries. All right. I highlighted certain things that should stand out. In this scenario, as practitioners, we have to say, I'm going to go to the next slide. We have to say, wait a minute. I have a client who's 22 years old with sons aged 10 and 11. How is that possible? Is it impossible? No, it's not impossible. I did, right? I said I met their mom, and she had kids. There's no explanation of how the children are related or provided. Therefore, here's some of the questions that would have. First of all, before we get to the questions, we as practitioners have to say, something just seems strange about this. I'm not calling anyone a liar. We don't sit here and call people liars. But we do have to ask questions. The IRS does not want us being data entry people and just, hey, oh, you're 22 with a 10-year-old and 11-year-old. Okay, let me put that in. Okay, your refund is blah, blah, blah. That's not what they want us to do. They want us to spot the inconsistency, address the inconsistency, and move on, if you remember that from earlier. So this here should trigger, forget about what questions to ask. It should trigger that we have to ask questions. That's what we need to establish. I need to ask some questions about this because something seems incomplete, incorrect, or inconsistent. Here's the questions I would ask. And this is how we do our questions. We do Q and we write the question. We do A and we write the answer. We don't do no long paragraphs and no long story and a thesis and an essay. We don't have time for all that. We don't do all that. Okay, like King T'Challa said in Black Panther, we don't do that here. All right. So, question: what is your relationship to each child? The taxpayer says they're my sons. Stop right there. Is everything cleared up? No, it's not. I'm still confused because you're 22 with a 10-year-old and 11-year-old. So I need to ask another question. Are they your biological children? Adopted, foster children, other? They're adopted. All right. I want to ask another question. What was the date of the adoption, and did they live with you for more than half the year? Right? Because they may have just been adopted last month, December 3rd, right? And we're preparing to 2025. They may have been adopted December 3rd, 2025. So we need to know. Taxpayer says January 2nd of last year. And yes, they have lived with me for more than half the year. Last question from me. In the event of an audit, can you provide the IRS with legal adoption paperwork? Taxpayer says yes. I am done my due diligence. Now, somebody out there would say, well, I want to see this adoption paperwork. More power to you. You're not wrong for doing that. It's not a requirement, though. That's all I'm saying. Jason Daughtry's not collecting that adoption paperwork. Lisa Daughtry's not collecting that that adoption paperwork. Our employees that's watching, you're not collecting that adoption paperwork. What the other 2,500 people do in this webinar, that's on them. If you guys want to collect adoption paperwork, you can, but it's not a requirement. I do warn you though, remember what due diligence is about. It's about spotting inconsistencies. So if you collect documentation for due diligence, make sure the documentation does not create new inconsistencies because you just eliminated the due diligence that you did. I'll give you an example of this. Get off adoption for a second. This is a real life example. We had a preparer out in California we was representing in an audit. They prepared their files, and without us, because we was in New Jersey, we flew out there. Revenue agent comes, and I'm gonna give you an example of a case. This is a little while ago, so my numbers may be a little off, but I'm making a point here. Taxpayer, this is the client of my preparer client, right? The file that the revenue agent's looking at during the audit. Single mom, one child. Single mom made $48,000 a year with one child. Nothing about that seems incomplete, incorrect, inconsistent. Not a problem. Everything's good. Except in the file, there was a lease. Okay. That lease said this mom's rent was $4,000 a month. So because that lease was in the file, the revenue agent says, wait a minute. If the rent's $4,000 a month, 4,000 times 12 is $48,000. How is this single mom providing for herself and her daughter on $48,000 a year when her rent is $48,000 a year? Because that question wasn't asked in the preparer's notes, that preparer was penalized. If that was Jason Daughtry's office, the lease would have never been in the files because we don't collect the lease for due diligence. The lease would have not been in the file. It wouldn't have raised that inconsistency. We would have been good. So there's two different ways for this to be right. I know accountants, it's hard for two things to be right? It's either right or wrong. That's not how it is. There's two ways this scenario could be right. One, the single mom, $48,000 a year, one child, no documents. Nothing about it seems incomplete, incorrect, inconsistent. The other right way is with the document, say the lease in this example, $48,000 a year, one child, with a note saying, how do you provide for yourself and your daughter on $48,000 a year when your income is $48,000? Answer, taxpayer receives $50,000 a year in child support. 48 and 50 is $98,000 a year. It now makes sense. You don't need a copy. In this case, you don't need a copy of the child support agreement. You don't need any of that. You just have to have the question and the answer. Both of those scenarios are right. In our office, we do it this way with no documentation. In the preparer we represented office, they collected the lease. They should have had the question, how do you provide? Answer, child support, whatever it may be. It makes sense. That's how due diligence works. While I'm here, I do want to say something that I don't know if I mentioned this earlier. I don't even know if I didn't. It might be coming up later. Again, understand due diligence is not just asking questions. It's asking questions when something is incomplete, incorrect, or inconsistent, when something seems weird. It's the weirdness, it's the addressing of the inconsistency that is due diligence. That's why when I said earlier, asking regular tax law questions is not due diligence. It's when something seems weird. Those questions are the due diligence. Is that your child is not due diligence, right? That's not due diligence. It's due diligence when it's an inconsistency about that being your child. Okay, I hope that makes sense, and we're going to get more into that as we go through this, and hopefully there's some questions. Here's another example from Treasury regulation, and I'll read through this. Preparer E knows from prior social interactions with S that the children resided with S for more than one half of the 2018 tax year, and that children did not provide over half of their own support for 2018 tax year. To meet the knowledge requirement, Preparer E must make the same reasonable inquiries to determine whether S is eligible to file as head of household and whether each child is a qualifying child for purposes of EIC and the CTC, as discussed in example 5 of this section, and Preparer E must contemporaneously document these inquiries and the responses. Prior knowledge is irrelevant. That's what this example is saying. It's saying Preparer E knows from prior social interactions, blah, blah, blah. That's the point here. What that means is Preparer E must make the same reasonable inquiries. I have a daughter. I have 2 daughters. I discussed that. Each one has 1 child. My oldest daughter has a child. She's unmarried. Every year I prepare her return, I have to ask my daughter, where is the father and how come the father is not claiming the child as a dependent? Even if the father's sitting right here, I have to ask that question. That is due diligence. Okay. I try to stay away, and I'm gonna get back to that, but I try to stay away from telling people in these classes what questions to ask. So that's a common question. What questions should I ask? My job isn't to tell you what questions to ask because your client's not sitting in front of me. My job is to try to show you that when to determine when questions should be asked. What those questions will come into play when you realize that a question needs to be asked. There's only 3 questions that I'm going to say have to be asked, and I'm going to say one of them right now. I just said it. Anytime you have a return with a child and both biological parents are not on that return, meaning both biological parents, mother and father, is not claiming the child, you must ask about the missing parent. So every single mom, you have to ask about the biological father. My daughter is a single mom. Every year I have to ask, where is the father of your child and how come they are not claiming the child as a dependent? I'm not saying my daughter can't claim her child. I have to ask that question. My daughter's answer is, me and my child's father live together and we have an agreement that I will claim my child. As long as I write that down and it makes sense, meaning it makes sense that she could take care of a child, then I'm good. My daughter makes very good money. I look at her income. I have no reason to think that there's nothing about my daughter claiming her child seems incomplete, incorrect, or inconsistent. I'm done. So, single mom making $100,000 a year, 1 child. Only thing I'm really asking is where's the father and how come they're not claiming the child as dependent? You guys live together, that's fine. Write that down, we're done. Same single mom making $12,000 a year with 5 children. Now that something seems incomplete, incorrect, inconsistent because the income is low compared to the number of children. So that's how you have to assess the information. I hope I'm making myself clear. It's not what questions do I ask. You're not going to find random questions. Just you should ask this question, you should ask that question, because you have to take the information in front of you, assess it. Does anything seem weird about this situation? And your questions have to address that weirdness, whatever that weirdness is. Truck driver making $100,000 a year, no questions need to ask. Truck driver making $100,000 a year that's blind, I might want to ask a question. How are you a truck driver and you're blind? See what I'm saying? So because the blindness came into play, now I have to ask questions. Income come into play, you might want to ask questions. Number of kids come into play, you might want to ask questions. Things like that. So one question, let's say I'm gonna give you 3 questions that you have to ask. One is, whenever the non-biological parent is not on the return, you must ask about that non-biological parent. If a grandparent is claiming grandchildren, you got to ask about both biological parents. If an uncle is claiming a niece, you got to ask for both biological parents. If it's a single father, you got to ask where's the mother and how come they're not claiming the dependent. If it's a single mother, you got to ask about the father. Again, nobody's saying nobody can't claim the kids or anything like that, but you have to address that inconsistency. So that's one. Okay. The other one, I'll say it right now. The other one, all Schedule C's, and we'll get to this part with the Schedule C's. Schedule C's, there is Schedule C. You notice we didn't mention Schedule C yet, but because net income affects EIC, we treat the Schedule C as if it's one of the due diligence concerns. So all Schedule C, you're going to want to ask, did you report all of your income to me? And did you report all of your income and all of your expenses to me? And how did you calculate those income and expenses? That question has to be asked for all Schedule C. Okay, that's not law. I shouldn't say has to. If you don't want to get penalized, you're going to want to ask that. You're going to want to inquire that the taxpayer gave you all the income and all the expenses, and you want to ask them, how did they calculate that income and those expenses? Answer might be taxpayer reviewed their bank statements and Venmo and Zelle and came up with their income and expenses. Okay, and I'll save the last one for when we get to it. So those questions have to be answered. I do want to pause here for Nicole, see if there are any questions about the 1, 2 requirement 1, 2, or 3, particularly the knowledge requirement. There's typically some questions that might be in that section.
Let me pop this up as I'm going through. Can you rely on prior year knowledge, such as taxpayers having social security numbers?
This is right on the screen now. Prior knowledge.
I'm sorry, can you repeat that?
Can you rely on prior year knowledge, such as taxpayers having social security numbers?
Well, social security numbers, you can rely on prior year knowledge when it comes to social security numbers. You cannot rely on prior year knowledge when it comes to due diligence concerns, due diligence benefits, meaning EIC, American Opportunity Tax Credit, the dependent credits, or head of household filing status. Everything else, you can rely on prior year knowledge. You can, you can bring over stuff from previous years, things like that. So again, there's no requirement to collect a Social Security card. So if somebody comes in right now, new client, right? I say, what's your Social Security number? They can tell me the Social Security number. I'm not saying that's a best practice. You want to see the card to make sure you get it right, but there's no requirement to get the card. If they're a previous client, they can come in and we bring up their prior year return and carry everything over. That's fine. We don't need any proof for that. The prior year knowledge or prior social interactions or anything previously known or otherwise known, none of that applies when it comes to due diligence. The example that I always give is, and this is true, hopefully this will answer the question. Here, right down the street in Atlantic City, I used to be a bouncer very long time ago to a strip club. And my job was to stand out front and collect ID. Okay, I just said I have adult daughters. Let's just say I was at that strip club still checking IDs today. And my daughter, I'm not going to say her age, but she's well over 21. My daughter walks up to the clubs and wants to get in. My job is to check IDs, regardless of if that's my daughter, regardless of prior knowledge. I know this woman, she's my daughter, but that doesn't change my job. I still have to check her ID, right? I have to show the ID. I can't just say, oh, that's my daughter, go ahead in. I didn't do my job. I'm using that analogy, that example, because when it comes to tax preparation, it does not matter who we know. It's not about us. We have to do our due diligence, meaning If something seems incomplete, incorrect, inconsistent, we must make reasonable inquiries, document those inquiries, document the answers, and keep the inquiries and the answers on file for 3 years from the due date of the return. We have to do that. Prior knowledge is irrelevant. Okay. So one thing I like to tell people, and this is what the IRS will say also, you have to prepare a return for a disinterested third party. That's the word, disinterested third party. Don't make it about you. Oh, well, I know this person. I was there when they gave birth. It's not about me. It's not about what I know. If I reach in this file cabinet and pull out any file, I should be able to give it to a disinterested third party, meaning one of the 2,500 people watching this webinar. And you should be able to open that file and read it without me saying anything and be able to tell the story. The fact that I know is totally irrelevant. So one way you could think of it is when you prepare a return, when you're done with that file, can you give that file to Jason? Give it to me. And when I read that file, I'm going to say, okay, your client is 22. Oh, I see they have a 10-year-old child. So they was 12 when they had the child. Somewhere in this file, there should be a note addressing that. And that note can't say, oh, I know this person, because that doesn't answer it for me. It may answer it for you, but I'm the disinterested third party. So you're always preparing a return for a disinterested third party. And that disinterested third party should be able to understand what's going on, and all inconsistencies should be cleared up to that disinterested third party, not to you. Any other questions, Nicole?
So there's several questions about the new Social Security requirement for certain credits.
Okay.
I don't know if you want to discuss that
Well,
or we want.
here's what I'll say about that. I don't want to discuss the actual requirement, but I do want to discuss due diligence, okay, when it comes to the requirement. And what I'm going to say to that is there is no requirement to collect or rely on any document for due diligence. So what they're saying is no refundable credit if you have an expired work ID. Or I'm sorry, not expired, I'm sorry. A Social Security card not authorized for work. So you need a Social Security card from DH with that has a unexpired work authorization. The IRS is not saying, Congress is not saying we have to see a Social Security card. What I can say is, hey, taxpayer, do you have a valid Social Security card with an unexpired work ID? Yes, I just did my due diligence. There is no requirement to physically see the Social Security card. None. Now, is it a best practice to do it? Sure, you can do that. But keep in mind what due diligence is. Due diligence is, it's not asking for the Social Security card. Due diligence is when something seems incomplete, incorrect, or inconsistent, in this particular case, about the Social Security card or about the work authorization. If something seems incomplete, incorrect, or inconsistent about that, you must make reasonable inquiries. If Congress wanted us to collect the Social Security card, then they could have just easily put into the Treasury regulation, collect the Social Security card. Just like we have to have a W-2, right? They say you can't use your last pay stub to prepare a return. You have to have the W-2. Congress says that. If you can't get the W-2, you can do a substitute W-2 and after mid-February. Like, Congress wrote all that into the law. If Congress wanted us to collect Social Security cards, they wouldn't have said make reasonable inquiries. They would have said collect Social Security cards. So can you collect Social Security cards? Sure. Can you collect the work authorizations and all that stuff? Sure, if that's what you want to do. Can you collect immigration status if you want? Sure, you can. It's not a requirement. You can do whatever you want. You can collect urine samples if you want. That's your choice. It's not a requirement, though. Okay, so I hope that answers the question. I don't want to get into the work authorization in the actual tax law. What I can say is if there is something that seems incomplete, incorrect, or inconsistent about that situation, our job is to make reasonable inquiries. Our job is not to collect documentation, meaning we don't have to collect the social security card. We don't have to collect the work permits. We don't have to collect all that stuff.
All right. Before we get into record retention, I do see one question on knowledge base. Same-sex Italian couple moves to U.S. They tell me they are married and want to file marriage filing jointly, but I know Italian law doesn't allow for same-sex marriage. Due diligence would be to ask if they are in a civil union allowed in Italy, for example, or got married in a jurisdiction that does allow same-sex marriages. No marriage certificate, just ask and document. Is that correct?
That is correct. Let me clarify. All that, I don't know Italian law. So assuming everything you said is correct, right? Assuming everything that was is correct. Basically, and we'll think through this. Basically, what the question is saying, married couple, something about this married couple to me, the knowledgeable and reasonable and well-informed practitioner, right? This person who asked this question seems knowledgeable and reasonable. Something seems incomplete, incorrect, inconsistent. What is my job now? That's what I want everyone to get out of this. This is the situation. Something about it seems weird to me. What does that trigger? And here's the answer. That triggers me making reasonable inquiries, documenting those inquiries, documenting those answers, and keeping those inquiries and those answers on file for 3 years from the due date of the return. In this example that the person asking the question is saying, yes, you ask about it, you tell them the law, you ask them about it, and if their answer clears up that inconsistency, yes, we was married in New Jersey where same-sex marriage is perfectly fine, or blah, blah, blah. You would write that answer down. You would write your question down. Now you can give that file to a disinterested third party, me, and I can read this, say, wait a minute. I would open that file and say, wait a minute, John and Fred are married, same sex. Something seems weird. Oh, here's the explanation. Here's the question that was asked. Here's the answer. That makes sense. We're good. You just passed your due diligence. I hope that I answered that question.
Yes, I think we are good to go and move on to record retention.
Okay. With record retention, keep in mind, if there's any other questions that someone think of that wasn't answered, we'll have more time at the end to catch all those questions. Record retention, everything that we talked about so far. Requirement number 1, the actual completed 8867. Requirement number 2, the actual computation of the credits. In requirement number 3, the notes for the knowledge requirement and any documentation. Remember, documentation, if any, that you relied on to determine eligibility, all of that stuff becomes part of the record, and now we must retain all of that. And this is what I just listed. The tax return preparer must retain a copy of the following: Form 8867, completed worksheets used to determine the amount of each credit. That's the credit computation. A record of how, when, and from whom you received the information used to complete Form 8867 in the worksheets. Documents that you relied on, if any, to complete the 8867 or the worksheets. You keep them. I always cut it short and just say 3 years from the due date of return. but you know Congress doesn't make things easy, right? So there's different caveats. So 3 years from the due date of the return, excluding extensions, or the date the tax return or claim or refund was electronically filed, or if not e-filed, then the date you presented the tax return or claim of refund to the client for signature. If you prepare it and another preparer completes and signs the return or claim a refund, the date you submitted it to the signing tax return preparer. While this is on my mind as far as record retention and this documentation, a signature on due diligence notes and documents and stuff like that is totally irrelevant when it comes to the IRS. I don't care if you get it notarized. I don't care if you have them sign this. In fact, this is not what I'm about to say is not law. This is just my opinion. This is from years of having conversation with revenue agents during and after due diligence visits. Don't hold me to this. This is not law. It's just a story and just an opinion, and it makes sense to me, so I want to share it. Signatures, from what I understand, from what I hear, signatures on due diligence documents and notes, meaning here, client, sign this. It's actually a negative when it comes to your due diligence visit. What it looks like is, as a preparer, I'm saying, here, taxpayer, this seems incomplete, incorrect, inconsistent, but sign this so I can cover myself. Going back to when I was bouncing at the club, imagine somebody coming in, they look a little young, they might be 22, they might be 19. I don't want to ask them for an ID. Here, sign this saying you're over 21. That's what it looks like. Instead of just doing my job, checking the ID, it looks like I'm not doing my job. Sign this to cover me. Now, can the IRS hold that against you? Can the revenue agent say, you know what, this looks like, because you signed it, it looks like you didn't do your job? No, they can't penalize you for that. But what can they do? Refer you to OPR and let OPR handle it. So I'm just going to say this. There's a lot of people that say, I do XYZ and I have my client sign this. That signature means absolutely nothing. I do understand, again, we use Drake, and Drake spits out due diligence forms with a signature line at the bottom. Our clients don't sign that. It's totally irrelevant for due diligence purposes. I keep saying that because I can see in a world where maybe in civil court, like if your client took you to court, state court, and said, you know, the IRS audited me and penalized me, and now I'm suing my preparer. I never told them that I provided over 50% of the upkeep and maintenance of my home, and they put me ahead of household. You can then pull that out, and maybe in court, I'm not an attorney, but maybe in court that would hold up and say, hey, yes, they did, case dismissed, hopefully. But as far as a due diligence audit, it doesn't matter what you have signed. It doesn't matter what you have notarized. None of that matters. In fact, anecdotally, just the story, you know, from what I'm hearing, it actually makes things look worse. I don't like the ideal of having taxpayers sign off on due diligence stuff, because I agree with the IRS, with the revenue agents I've been speaking to. I agree. That's what it looks like. It looks like you don't want to do your due diligence. So to cover yourself, you're going to get the taxpayer to sign off on this. And paid preparer due diligence is not about the taxpayer. It's about you and what you do. Okay. Which is also why it doesn't matter that you know your clients, and my clients don't lie to me, and my clients, and because it has nothing to do with the clients. It's about what I do, right? It's about me doing what I have to do. So that is the record retention. Those records can be kept electronically or paper format. I see a lot of questions on Facebook. Where should I keep my notes? It doesn't matter. I get that question probably once a week. Where should I keep my notes? How should I keep my notes? It does not matter. You can keep it in your software. You can keep it on a piece of paper. You can keep it on a napkin under your bed if you want. It does not matter. as long as you can pull them up in the event of an audit and keep them organized. Now, some people say, do the notes go with the return when you electronically file? Drake doesn't. I don't know. Maybe some software does. It really doesn't matter to me. But you can keep them electronic or paper in the software. You can do a Word document. You can do it however you want. Don't overthink it. Don't overthink that. Notes can be kept in all the records can be kept in any way, electronic or paper. Any questions about record retention, Nicole?
So the main, pardon me, comments in the Q&A are about line 5 of the 8867 with not keeping the documentation. How do you answer that?
Well, so line 5 says list the documents, if any. So that's the key part. If you are relying on documents, then you would put those documents on line 5. We're not relying on documents. I know that's hard for a lot of people to fathom, because a lot of people are taught you have to collect this, you have to collect that, but you don't, right? You don't. There's no requirement to rely on documents for due diligence. So is that so? The question, can you ask the question again, Nicole?
So it's specifically like the AOTC, when you're using the 1098 or the bursar statement to calculate the credit, how do you not keep that?
Well, again, you are keeping it if you are relying on it to determine eligibility.
Okay. Let me just make sure I got all the line 5 questions addressed.
Again, I just want to be clear. If you're relying, you might be over there. I have a pen here. If I'm relying on this pen to determine eligibility for the American Opportunity Tax Credit, then I'm going to put pen on line 5. In my office, I'm not relying on this pen. So therefore, my line 5 is blank. But in your office, you might be relying on that pen, or you might be relying on whatever form you're relying on.
Right. And you leave line 5 blank. The concern is that the software doesn't let you move forward if you leave line 5 blank.
Well, I don't know what software I did address that. I don't know what software anybody's using, but the software, if the software is, first of all, the software can't make you put a document, right? If it won't let you move forward, it has to be a not applicable button. It has to be something to say none or NA, but it can't just like you have to choose something. In Drake, I can speak on Drake. Drake has school record, medical record, lease, letter from pastor. Then there's another box that says did not rely on documents. And then there's another box that says did not rely on documents, made notes to file. That's the box we always collect. And when we always press. And when we press that button, it leaves line 5 blank. How other software work, I don't know, but no software can make you put something that's not there. So, and if your software is not letting you do something, then that's a software issue.
Yes. I think that we have covered everything.
Okay. I encourage people, anybody that's in Tax Professional America, the Facebook group Tax Professional America, knows for the last forever, I've been encouraging questions. I told people to come to this webinar with the questions. I want to answer every possible question, right? So if you think of a question, no question's too dumb, too small, too big, too little, ask the question, put it in the Q&A, ask, okay? I want to resolve whatever confusion there is. I don't want to be part of the problem and create more confusion that's already out there with due diligence. Okay, so we'll move on to the next section, but we're going to answer these questions at the end write them down so you don't forget them. Put them in the Q&A, and we'll get to them. Consequences of not meeting your due diligence requirements. There's three categories of people who can be harmed by not meeting the due diligence requirements. One is employers. Anyone like me and my wife that have employees, we as employers can be hit with due diligence penalties if one of our employees get audited and are found is found to not have met their due diligence requirements due to a systemic issue. Okay, the best way for an employer to protect themselves is number one, show the IRS that there is a system of due diligence, meaning this is our process in our office. Yes, maybe our preparer didn't follow that process. That's why they got penalized. But this is our process. That protects the employer. It's not one or the other. It's not me or my employee. It's my employee getting penalized and also me as an employer getting penalized. So if I can get out of it, that's fine. I'm not pushing it on my employee. It's either both of us or one of us. So we try to limit that by at least clearing us. So you want to show as an employer that this is our due diligence process in our office. That's number one. Number two, what we do is we have all our employees, and I recommended this, I said this earlier, we have them take the IRS due diligence webinar every year. It's every January. It's free. Again, we don't have them take it to learn anything because I don't trust the IRS to teach this stuff. We take it so they can get a certificate from the IRS saying they took this seminar, and that's our proof as employers that we are requiring some type of due diligence process. That is what protects us as employers when our employees fail due diligence visits. So employers can be harmed. Then our clients can be harmed. If the IRS audits our clients, they got to be forced to pay back the money. They can be barred from collecting EIC and things like that for the 2 years versus 10 years if it's considered fraud. We all know that pesky 8862 when we file a return and it's rejected because of the 8862. They have to complete that for a number of years. That's all the issues our clients face. And then there's you, us, the preparer. We can get hit with other civil penalties ranging from $1,000 to $5,000. Remember that's 6694A versus 6694B. We can get suspended or expulsion from the IRS e-file. We can have this get hit with disciplinary action from the IRS OPR. We discussed that. We can get injunctions barring you from preparing tax returns. That involves the Department of Justice. And then, of course, there's criminal penalties for filing fraudulent returns. All of this can stem from a due diligence visit. This is why, and I don't think I mentioned this yet, but I do believe, I know anybody that's followed me on social media knows I feel strongly about this. All practitioners should, it's not a requirement. I am very biased, but I do believe all practitioners should have representation in a due diligence audit. If I was ever audited, I would not represent myself. I would get my wife to represent me in that audit. The main reason for representation is to serve as a buffer between the IRS and the preparer. Also, a good representative is going to help limit some of those treatments by OPR. Remember, the revenue agent has to make a decision whether to refer you to OPR. If they make that referral, depends on your representation and also what OPR does. Depends on the representation. I did want to mention something. I want to go back to the OPR thing. Remember, the IRS is about correction, not punishment. This stuff isn't punitive. They're not trying to punish. They're trying to correct. The IRS wants good tax preparers so people can pay their fair share, effective tax administration, pay your taxes. They want good, knowledgeable preparers. So they don't want to shut people down unless they have to. They want them corrected. One way to limit your OPR exposure is to already have corrected, which is why my preparers that I'm representing this week coming up is taking this webinar, because if they do get referred to OPR and OPR wants to make mandatory due diligence training, we can say, hey, already did that, right? So we're trying to correct it before the IRS has to correct it. And that's what we want to try to show, that we've taken corrective action. And that's what any type of audit you want to show, that's what you did. You want to beat OPR to the punch, so to speak. So those are the three categories of people that can be harmed by not meeting your due diligence requirement: the employer, the taxpayer, and us as tax professionals. There is no such thing as penalty abatement for, there's no first time penalty abatement for due diligence penalties. Technically, there's no reasonable cause abatement for due diligence penalties. There's what they call reasonable cause like factors. It's basically a case by case scenario. So there's absolutely no first time abatement for 6695G due diligence penalties, but there may be an argument for a reasonable cause like abatements. All that is IRS speak for we'll see. Tell us what the problem was and we'll see. Okay. One thing that I do know for a fact, far as penalty abatement, one thing that happens all the time is identity theft. When somebody uses somebody else's P10 and you get audited for a due diligence audit, you get your list of 25 and there's like 4 names on there that you don't even recognize. The IRS can trace that to the IP address. And I'm here in New Jersey, and if they see that those 4 returns was filed in Louisiana, that's my argument, that I didn't even prepare those returns. Someone compromised my P10, someone else prepared those returns. That would be a reasonable cause, like reason for an abatement. Other than that, there's pretty much not any reason that the IRS is going to abate a due diligence penalty. Bulletproof your office and procedures. In the handouts, I have some worksheets that we use in our office. I'm raising my hand again and saying this is just what we use in our office. It's not right. It's not wrong. It's just what we use. Keep in mind, I'm a 52-year-old dinosaur. I'm not very good with technology. I still use a lot of pencil and paper. Some of the younger people, they got apps for everything. If that's easier, use that. But in the handouts, we have what we use. We do kind of like a hybrid thing. And this is the segment where we talk about bulletproof in your office. One thing I say is do not use questionnaires or intake sheets in lieu of due diligence notes. We have to say the whole sentence. Some people read that to say, oh, Jason said you can't use tech questionnaires. That's not what I'm saying. What I'm saying is you can't just use questionnaires. Okay, you can't just use intake sheets. One thing I've been finding lately, when I interview preparers, when they retain us, is a lot of preparers view the questionnaires or the intake sheets as due diligence. And that's not it. The intake sheet should be a tool used to draw out questions, to make us ask questions. So we're using the information on the intake sheet to generate questions to ask to determine eligibility. Oh, okay. I see here they have I use the example from the Treasury regulations. I see here they're age 22. They have 2 children, age 10 and 11. That brings up, I got to ask a question about this. And that's just how it would be done. Say, for example, someone goes to your website and does the intake sheet online, and now you see it on your screen. and that scenario comes up. Age 22, 2 children, age 10 and 11. I would write a note. Okay, when I talk to the taxpayer, I got to ask them about this. What question am I going to ask? Here's the question I'm going to ask. I'll wait for an answer. And I'll go through the intake sheet again. Oh, I see here the income's kind of low. Okay. They got 5 kids, $20,000 a year. Okay, when I talk to this taxpayer, I'm going to ask them, how are they providing for themselves and their 5 children on $20,000 a year? I got to remember to ask that. Go through the intake sheet. Oh, I see here, this is this. That's exactly how it has to be done. I'm not using the intake sheet as the solution. I'm using the intake sheet to generate my questions. My questions are going to be done on my notes section. And based on our information, we have a center section, a blank spot where we put our additional notes. So I call that the golden rule. Do not use questionnaires or intake sheets in lieu of due diligence notes. You need the due diligence notes. Include due diligence language in your engagement letter. This is my opinion. This is what we do. I should have some, sure. So including due diligence language in the engagement letter. This is our engagement letter language. It's longer. I'm going to read it word for word, but there's more to it. But this is just an example. Client responsibilities and due diligence requirements. Federal law imposes specific due diligence requirements and on tax return preparers when determining eligibility for certain credits, including but not limited to earned income credit, child tax credit, blah, blah, blah. To comply with these requirements, we are required to ask reasonable and appropriate questions, request additional information or documentation when necessary. Notice I said or documentation. Don't say, well, I thought you said we don't need documentation. You don't. Okay, this is just my engagement letter terminology. Request additional information or documentation when necessary. Verify the consistency and completeness of information provided, and complete and retain required due diligence records, including IRS Form 8867. This is just something that we have in our engagement letter, and that's obviously what we get taxpayers to sign. One reason why I like doing this, because there's a lot of times where people may feel a little uncomfortable asking the same question over and over, or year after year, or whatever it may be. We are trying to establish to the taxpayer that this is the law. This is just what we have to do. Okay. And that's why we put it in our engagement letter. We don't necessarily put it in there as some binding, this is a contract, you have to answer our due diligence. No, we just do it just to let them know that this is a requirement by law. You can get more fancy if you want to put under IRC 6695G and sound real smart and all. You can do all that, but that's up to you. The concept, the ideal here is that include due diligence language in your engagement letter. And then one way to bulletproof your office is just use common sense. This is what the IRS wants. They want us to just use our human brains to assess information. I talk to my wife all the time. Like, I always use the income thing. And I think one problem that I've determined, I've realized by talking to so many practitioners is some practitioners, they feel the goal is to maximize a refund or get the biggest refund. When you have that goal in mind, it's harder to do due diligence because your motivation is something else. When your goal is to prepare a complete and accurate tax return, it's easier to come up with questions, right? Forget whatever the refund's going to be. At the end of the day, I really want to know, how are you providing for yourself and your 5 dependents on $18,000 a year? It's just me, my wife, and my dog, and times are rough. We were out here, eggs are expensive. That, like, I actually want to know, right? Forget about due diligence. I want to know, how are you doing this? And I think that's the mentality that we got to have. Certain things just has to seem inconsistent, not necessarily a lie, There's plenty of ways someone on $18,000 a year can provide for a family of 5. Child support is the perfect example. Maybe on December 31st, the prior year, they hit in the casino down the street for $300,000. In the next year, the year we're doing their return, they quit their job. So now they got a W-2 because they worked a little bit in January. Now they got a W-2 for $3,000 and they got 5 kids. How did you provide for yourself on $3,000 for the year with 5 kids? Oh, the previous year, I hit in the casino for $300,000. Now, I know some of you say in this example, well, let me see the prior year return. If that's what you want to do, perfectly fine. It's not a requirement, though. Okay. So just use common sense. That's what the IRS and Congress is trying to say. Use common sense. I had and I hope this person don't mind. I know they're watching, but I had an interview last night, and I said, I was on the phone with them, and I said, okay, tell me one of your files. Just bring up a random file. And they brought up a random file, and they said it was a Schedule C person, $24,000 income. I said, okay, is that net? They said, yes. I said, what's the gross receipts? 3 kids, by the way. They said 24,000. I said, so they don't have any expenses? No. What's their business? Hairdresser. Is it common for a hairdresser to not have no expenses? First of all, it's not common for a business to have no expenses at all, period. But it's also really, really uncommon for a hairdresser. Now, I told this tax preparer, I know what they're going to say, because keep in mind, 24,000 there, sweet spot, EIC3, I get it, right? What they're going to say is, yes, I do hair. The taxpayers, the clients buy all the supplies and stuff like that. We know how this goes, right? So the question has to be, so you made $24,000. How many clients is that, right? How many heads is that? How much hair is that? Is that 50 people, 100 people? I don't know. But you're saying 50, 100 people, all 50 or 100 people bought their own supplies, their own hair, their own hairspray, their own mousse, whatever it is. That just doesn't seem right, right? So we have to use common sense. I'm not calling you a liar, but I need to ask more questions. And we're even going to get into more questions and how to call people liars without calling them liars. So the best way to bulletproof your practice, know the law, evaluate the information received from clients, apply a consistency and reasonableness standard to the information, make additional reasonable inquiries when the information appears to be incorrect, inconsistent, or incomplete, and then document additional inquiries in the client's responses. Since net income is crucial in determining certain credits, net self-employment income also falls under the due diligence requirement. Before I get into the notes, I want to address that last thing. Remember, I said I was going to say 3 questions that you have to ask. Okay. First one was whenever there's the whenever both biological parents are not on the return, you have to address where is the missing biological parent. Schedule C, the other one I said we got to ask, have you reported all of your income and expenses to me? And how did you calculate your income and expenses? That has to be questioned. The last one that always has to be addressed is American Opportunity Tax Credit, non-traditional college age, meaning 24 or older. Anybody, I use myself as an example. I'm 52 years old. Let's say I never went to college before in my life. I come to somebody, get my taxes done, and now I have a 1098-T college. I spent $5,000 and I want the American Opportunity Tax Credit. Because I'm 52 years old with all this gray, I'm of non-traditional college age, you have to address that. You have to bring up, hey, and the way I do it, I don't say you're an old fart. You know, I don't say that at 52. I say, I go over the rules. In order to get the American Opportunity Tax Credit, you must be in your first 4 years of post-secondary education. You must can't be convicted of a felony, blah, 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 whatever the requirements are. Do you meet this requirement? I say yes. You just did your due diligence. If you write that question down and write my answer down, you just did your due diligence, because I'm of non-traditional college age. If I was 20 years old, you don't have to ask that question because I'm of traditional college age. Remember, asking about the American Opportunity Tax Credit or any of these benefits from tax law standpoint is not due diligence. It's when something seems weird. I'm getting a college credit and I'm 52. That seems weird. It seems incomplete, incorrect, inconsistent. It doesn't mean I'm wrong. It doesn't mean I don't apply. It just means it needs to be addressed. Okay. A 20-year-old, nothing seems weird about it, so it doesn't need to be addressed. Whether that 20-year-old is entitled is totally irrelevant, right? Because imagine if that 20-year-old, when he was 16, he went to college. When he was 17, he went to college. When he was 18, he went to college. And when he was 19, he went to college. All 4 years got the American Opportunity Tax Credit. Now they're 20, sitting in your office, and they want the American Opportunity Tax Credit. Well, if you don't know about those first 4 years, then nothing seems incomplete, incorrect, inconsistent. Therefore, due diligence, meaning when something seems incomplete, incorrect, inconsistent, you make reasonable inquiries, does not have to be done on that 22-year-old, on that 20-year-old. But of non-traditional college age, then the due diligence has to be done. And again, when I say due diligence, I'm not talking about just ask questions. I'm talking about asking questions that clears up when something seems incomplete, incorrect, inconsistent, not just questions. Okay. Notes. Keep it simple, silly. If you have questions, we're going to get to that. We went over this one. Where is the biological parent of your children, and how come they are not claiming your children as dependents? Answer: other parent lives with me and agree that I will claim them. This is how we do it in our notes. We do Q, write the question, A, give the answer. It doesn't, you don't have to say, I asked the taxpayer, did they have children? Taxpayer said yes. Taxpayer said children. You don't have to do all that. We keep it simple. Q, question, A, answer. Next one. Q, question, A, answer. That's how we do it. Another example. Did you report all of your income, your business income and expenses to me as disclosed on your tax return? If yes, how did you come up with your income and expenses? Yes, totaled up all my income and expenses from bank statements. Okay. Just last night on this example, when I went over this question with the preparer, I asked that question, if you ask your taxpayer, did you report all of your business income and expenses to me as discussed on your tax return? And the preparer said, what if they say no? Okay. And that's an interesting question. What if your client says, no, I didn't report all of my business income? Then obviously we cannot prepare the return. We can't do it. When you're thinking about getting a refund, you want to still prepare the return. At the end of the day, when your goal is to prepare a complete and accurate tax return and not just maximize a refund, then it's easy to say, I can't prepare this return. You didn't give me all your income. It's almost like, hey, I see you gave me 3 W-2s. Do you have any more? Yeah, I have more, but I'm not going to give them to you. Then we can't prepare the return. That's how this works. Okay. Last example. In the event of an IRS audit, the IRS will require you to provide substantiation of your income and expenses. Can you provide that to them? Taxpayer, yes. Okay. These are just examples of notes. Can't see this really on the screen, or at least I can't really see it on the screen, but this is how it prints out in Drake. Those are the questions that I just asked. This is, it's QA, QA, QA. This is how we do it. You see at the bottom, there's a signature form that is blank. Like I said, we don't sign that stuff. Polite ways to ask uncomfortable questions. If anybody watching this webinar is still uncomfortable asking questions, I'm not uncomfortable. I will ask my daughter. I've known both of my daughters for 30 years, right? They're not biologically mine. Like I said, just like with the example, I met them when they were 10 and 11. I've known them for 30 years. And for 30 years, well, not 30 years because they was 10 and 11, but as for as many years as we've been preparing their returns, I have absolutely no problem asking them the same questions that they know I know the answer to, because they know it's not about what I know. I have to check the ID. I have to do my due diligence. I have to ask questions when something seems incomplete, incorrect, inconsistent to a disinterested third party, not me, to a reasonable and knowledgeable preparer. Then I have to ask these questions. If you feel uncomfortable, this is what we do. You blame the IRS. Okay? Very simple. All my IRS friends on here, sorry, we're blaming you. This is how we do it. The IRS may ask me how you manage to support yourself and 5 dependents on $18,000 a year. What should I tell them? So in this scenario, I'm blaming the IRS. This isn't me that want to know this. The IRS. The IRS, when I electronically file this return, the IRS is going to call me and they're going to say, hey, we just got this return from your client. How did they manage to support themselves on $18,000 and 5 dependents? That's sarcasm. Just for, I forgot, there's some people that never prepared a return watching this. That's sarcasm. What I'm saying is that's the vibe that I'm giving when I'm talking to my clients about this. I will say it's the IRS asking. Listen, the IRS is going to ask me how you manage to support yourself in 5 dependents on $18,000 this year. What should I tell them? Oh, just tell them whatever. No, I can't tell them. I need an answer. I need to know an answer to get them. Well, just tell them that I receive child support. Okay, so you receive child support? Yes. How much do you receive in child support? $50,000. Okay, so now I'll put that down as my answers and my questions. So all I did was frame it to blame the IRS. Okay, this isn't me asking this. Your business seems to have low revenue but extremely high expenses. The IRS will want an explanation of this, and why would you continue to run a business at such a loss? What explanation should I give them? Again, nobody's saying this can't happen. Nobody's saying you can't have low revenue, high expenses. No one's saying any of that. We're not calling anyone a liar. What we're saying is it looks incomplete, incorrect, inconsistent. Questions could be asked by the IRS. I need to have answers. I got my pen, I got my paper, I'm ready to write the answer down. I need an answer so we can give this file to a disinterested third party and they can understand what's going on. Okay? We all want to go above and beyond for our clients. Well, hey, let's have our clients go above and beyond for us. Save me. The IRS is going to come after me and ask for these answers. Help me out with an answer that makes sense. All right. Did you and the biological father agree that you would claim your child? Do you understand the tiebreaker rules as I explained them earlier? This is one thing that we do. We explain the tiebreaker rules. The 8867, I think, is question number 9. Asked, did you explain the tiebreaker rules? That should always be checked yes if you explained it. And in our notes section, we are now asking, did you and the biological father agree that you would claim your child, and do you understand the tiebreaker rules? Taxpayer said yes. So those are sample questions. And another one is, I do not need to know your child's disability. However, if audited, the IRS would want proof of that disability. Would you be able to provide such proof? Those are samples of questions. I do want to get into IRM 4.19.14.1. I must reiterate, please, if you take anything away from this seminar, please remember that no documentation for due diligence is required. I want to address, in our office, we have 2 different files. we have a source documents file, we have a due diligence file. Our source documents is our W-2s, our 1099s, our things like that. Those are source documents. Then we have a due diligence file. In the event of a due diligence audit, we would give the IRS this file. The only thing the IRS is going to get is notes and profit and loss statements. That's it. We do collect profit and loss statements. We do collect a summary of client income and expenses for Schedule Cs. That would be in the file, but they're and notes. The leases that we collect for the New Jersey, right? New Jersey renters credit, that's in source documents, because we're not using that to determine eligibility for what? EIC, the dependent credits, head of household, and American Opportunity Tax Credit. That determination stuff is in this file, the due diligence file. Okay. Driver's license, this file. Okay. W-2s, this file, source documents. So they're separate. Now, some people aren't going to listen to me and going to say, oh, I was taught that we got to collect documents and school records, and I don't care what Jason says. I'm going to CYA, cover myself, cover my butt, and on. And more power to you. Here's a list of documents you can collect if that's what you want to do. It comes from Internal Revenue Manual 4.19.14.5. That's where the list of school records and lease and medical records and placement agency statement, all that stuff. The Internal Revenue Manual is the IRS's manual. That's for them to collect from our clients if our clients are audited. That is not for preparers to collect. So what I'm assuming happened maybe 30, 40, 50 years ago, okay, the IRS was auditing clients, and the clients needed their school records, leases, whatever it may be, birth certificates, social security card, all that stuff, whatever. And somewhere preparers said, you know what, I'm going to go above and beyond. I always make this joke because y'all, a lot of preparers like to go above and beyond. That's just not me. I might go above, but I'm not going above and beyond. I might just go a little bit above, but I'm not going above and beyond. But at some point, preparer said, I'm going to go above and beyond, and I'm going to collect this stuff. And somewhere along the way, we started thinking it's some type of requirement. It's not a requirement. In the event of an audit, the IRS is going to ask your clients for this stuff. That's their job. If you want to collect it, fine. You're just holding it for them. What I recommend, if you're going to be hard-headed and not listen to Jason, why anyone would not listen to me, I don't know. But if you're not going to listen to Jason, and you are going to collect all of this stuff, these documents, then I would charge the client for it, because you are risking $650 per violation times 4 per return, $2,600 per client. So if you're going to be storage unit and hang on to a client's school records or medical records or social security cards, have at it. I would charge them for that though, because you're being held liable for them. Another reason why we don't collect documents, I just want you to be mindful for, if you do decide to collect those documents, is one, if any one of us, our offices were hacked, we're all in trouble, right? Any one of us get hacked, we're in trouble. I just feel we're in more trouble if the thieves have actual physical copies of stuff. It's bad enough that you have the social security number, but you also now have a copy of the social security card because I have it on file. See, so the less I have on file, the better it is for me. That's how I feel. I don't want it on file for identity theft purposes to limit that. I also don't want it on file because those documents could create more inconsistencies, and none of it's required for due diligence. I must say that for due diligence, not requirement. But This is the Internal Revenue Manual. If you Google IRM 4.19.14-1, you'll see the list of documents that the IRS will ask your clients for. It's not a requirement for us to take. And this is actual screenshot from the Internal Revenue Manual. That's the list that you will see. So I hope everybody got something out of this. We'd like to answer any questions. On the screen is my email address. My phone number's on there. Our website's on there. If you have any questions, please feel free. I prefer email. Please feel free. If you have any questions now, Nicole, we can definitely answer those questions.
I'm going to post up the questions, but before we get to the questions, because I know a lot of people are going to drop off and not stay on for the Q&A. If you are logged in not under your correct name or your name appears as guest, there is a link at the top of the chat. It's just collecting your name, your email, and your PTIN and other credentials. Please fill out that link, because if your name is guest or you logged in with somebody else's link and your name is not showing, we don't know who you are and we won't be able to issue you CE credit. Please use the link at the top of the chat to make sure that your correct information is given for the webinar. Now I will start with also a housekeeping item. A copy of a textbook and today's slides are in the handouts tab. So please download them right from the handouts tab above the chat tab. If you don't, or you need them again, they will be available on the replay. You can access the replay when it's available, usually within 24 hours at taxpracticepro.com under the webinar section, or you can access the replay using the same link you used today. All right, so let's jump into. I did
want to say before people drop off, like I said, if anybody is interested in other representation topics, please let us know. You could let John know at Tax Practice Pro. You can email me. I don't teach regular tax law. I don't teach, S corps and stuff like that. All we do is instruct on representation topics. Like I said, prepare penalties and innocent spouse and things like that. So if you're interested in anything like that, you can email me, or let someone know, and I'm sure we can accommodate. So
thank you. I'm just going through some of these questions. I'm going to pop this up while I go through these questions. What is your best advice to give practitioners that receive the IRS warning notice on possible failure of due diligence?
Okay, great question. The warning notice, there's a ton of them. Warning notices are considered treatments. So when you get a warning, we talked about treatments earlier, right? That it's a corrective issue. When you get a warning notice, you are technically in the system, right? You're on the radar. So all you can do at that point is start preparing. Remember, you're not really preparing for the IRS. You're preparing for OPR. You're possibly preparing for appeals. You're looking ahead of the game. So any warning notice you get, you're going to want to make sure, okay, I want to take a webinar or something on due diligence, preferably from the IRS. Okay, I should have said that earlier. You want to recognize, I'm not talking about regular CE providers. If you can only take one, I wouldn't even take mine, right? You want something where the IRS sees it and they know it's theirs. So you always want to start with the IRS's webinar, so you can say, hey, I even took your webinar. Right? You're not really taking it to learn from them. You're taking it to show them that you're following their lead. So when you get a warning letter, start preparing by being able to document your efforts. You do that by taking the IRS webinar, maybe taking on due diligence, maybe taking other ethics webinars. And it's perfectly fine to say, hey, I received a letter. It worried me. I thought I might be doing something wrong, so I decided to take more education. That's perfectly fine to say, because what does that tell the IRS? Our treatment worked, right? You don't have to act like you knew it already. Like, oh, you sent me the letter, but that's not why I took education. No, you don't have to do that. You could say, yes, I wholeheartedly thought I was doing things right. Got this letter, said I might not be doing things right. I'm such a professional. I'm such a great tax professional. I said, you know what? I don't know what I don't know. Let me go out here and get educated. That's the vibe you're trying to give. You're trying to nip it in the bud before the IRS says we need to nip it in the bud. So that's the best advice I can give. If you receive one of those warning letters, get educated, start documenting your education and start documenting your efforts to correct whatever they're saying could be wrong.
Hey, Jason, let me ask you something here just as a follow-up. We see folks post all over different social media groups. They get the letter like every year or every couple of years. They're getting that you made too many mistakes on Schedule C, E, and A. So, but then I usually reply back, well, have you heard from these clients that they're getting letters or audit notices? And they're like, no. So can you comment to that? What does that say about some of these clients that are, maybe we're not collecting the due diligence, but when you get those letters, you're not hearing back from those people?
Yeah, I mean, that's actually a comment. I actually asked that too. Do you hear from the clients? And a lot of them say no. So
My clients tell me it was my fault. They start with, you made a mistake. So I know I hear from them when they get a notice.
well, my clients, they actually, my clients say I made a mistake. Lisa's clients say I made a mistake. Somehow I made the mistake, even when my wife prepared the return. So I haven't figured that one out yet. But yeah, that's a very, very common scenario. Is you want to inquire. I mean, you could inquire with the clients, or the clients, hopefully the clients reach out to you, but if they do, hopefully they're not saying you made a mistake.
I guess what I'm asking is, are we not saying no to some of these people often enough? Are these people that are on the line, they get caught, we never hear back from them. This is happening enough that the IRS is generating a warning letter to us.
It could be. I mean, the warning letters just means you're in the RPD, you're in the return preparer database. That's an algorithm based platform that the IRS uses. But I find that when you frame your questions the right way, the shadiness seems to cut itself out because stuff just doesn't seem to make sense. If you're really looking to make it make sense, right? So the more questions you ask, the more. So to answer your question, I mean, you would be saying no more often if you're asking better questions. I hope that kind of
answers. Okay.
One thing I did want to say that before, but I forgot to say it earlier, but some of the new stuff that the IRS is doing, it's always been in the Internal Revenue Manual, where when they went to 25 returns, auditing, the wording was a minimum of 25 returns, but it's always been 25 returns. Lately, they've been doing an additional 25 returns. This is part of this is part of the one of the new things. So they'll have a due diligence audit. They'll come out and do 25 returns. And if they're not satisfied with those 25 returns, they would do an additional 25 returns. So that's something that's always been allowed to be done. But in my experience, it was never done until recently. Another thing that they're doing lately, or they actually started doing more of this a few years ago, is in addition to the 25 returns that they're auditing, they would also audit the preparer's personal and/or business return, meaning me and my wife's personal returns that we file. If I was under due diligence audit, they'll do my 25 for my clients, but then they'll also audit me and my wife's personal return or our business return. And then lastly, the thing that's happening and a great amount of time this year, which they always had the right to do, but they very rarely did it, is they're doing second and third and sometimes even fourth due diligence visits, meaning someone was audited in 2023, they got their penalties, they got the referral to OPR, and OPR said, okay, come back out in 2024, audit them again. And then they got another referral to OPR, and they said, okay, in 2025, audit them again. The multiple due diligence visit is it's always been allowed, but it's been happening more and more and more. And so those are some of the newer things that's happening now. And I should have said that earlier. Any other questions?
Does the same concepts apply to business and corporate returns? I'm gathering they're asking in terms of due diligence.
Well, remember, due diligence is about is determining eligibility for EIC, the dependent credits, head of household, and American Opportunity Tax Credit. So any return that any of those are on, due diligence would apply.
There was a question, but I think you just answered it. What happens if there's no inconsistency? You do not need to do anything for due diligence?
Correct. Due diligence is about when something seems incorrect, incomplete, inconsistent, then you do your due diligence. Then you do your due diligence under 6695G. You ask reasonable inquiries. So the single guy, 30-year-old guy comes in, works at Target, a W-2, not a Schedule C, W-2, $30,000 W-2, no kids. You don't have to ask any additional reasonable inquiries because nothing about that seems incomplete, incorrect, inconsistent. And I think that's the biggest misconception about due diligence. And I said this in the beginning, a lot of people think due diligence is just asking questions. It's not, right? Due diligence is when something seems weird. If nothing seems weird, then there's no due diligence to be done. Okay? Due diligence is about clearing up inconsistencies. So ask questions when something seems incomplete, incorrect, inconsistent.
Okay, there was a comment that there was 3 must-ask questions.
Yes.
And someone only heard 2. What
Okay.
we're missing?
So real quick, when it comes to head of household, right? Or not necessarily head of household, but mainly head of household. Whenever the biological parent is missing on a return, so if both biological parents are not on the return, you have to address the missing biological parent. If it's a grandparent or an uncle or something claiming a child, you have to address both biological parents. If it's a single parent, you have to address the one biological parent that's missing. So that question, where is the biological parent and how come they're not claiming the child as a dependent? That's question 1. Question 2, Schedule C. Have you reported all of your income and expenses to me? If so, how did you determine that income and expenses? That's question number 2. Question number 3, American Opportunity Tax Credit. You have to address whenever there's someone receiving the American Opportunity Tax Credit that is of non-traditional college age. You have to, the way I do that, because that could be sensitive. You're telling someone they're old or whatever it is. There's no way you're in college. You know, you don't want people taking that. I just explain the law. Okay, I'll explain the law. In order to receive the American, and I actually write this down, in order to receive the American Opportunity Tax Credit, you must be in your first 4 years of post-secondary education. Are you in your first 4 years of post-secondary education? You know, and you're only really addressing that, writing that in your notes section when there's someone of non-traditional college age. Someone that's of traditional college age, which is 23 or younger, or I should say 18 to 23, then you don't have to address that.
Okay. I think we've pretty much covered everything. Yeah, I will look again. I'm just going to make one more last announcement. If you're not logged in under your own name or as guest, please use the link in the top of the chat banner to make sure that we record your name and credentials so that we can properly give you credit. John, I will turn it over to you. Jason,
First, I want to really thank Jason for doing this for me. It's about to be the busiest season going, and getting him. And I want to thank Lisa and Nicole for working for me this weekend. Everybody has other things to do, I'm sure, but we felt a lot of you would show up, and we had well over 1,000 actually stay for the whole program, Jason. So that's great. So thank you again for doing this for everyone. It will be available for replay. The way we're able to do things like this is we do have subscribers. We are a for-profit company at the end of the day. So if you're interested in looking at what we do, if you want a trial, you can go look. There's probably 30 programs available for free on the website that all issue CEDU as an on-demand. But if you want to join us, last chance offer. Prices are, we don't raise the price. If you join, I've got people paying the initial price when we started doing this in 2020. But the price will go up for new subscribers starting in May. So if you want to join us right now at $52 a month, by all means, there's a half off on the sign-up fee for the next couple of days. So scan that and join us, and everything. This will be available on demand. Give us about 24 hours for the video to process, and we'll get it up there on demand. If you need anything in the meantime, please give us an email. And again, Jason, I can't thank you enough for doing this for us.
No problem. No problem. No problem. Thank you. Thank you.
All right. Everybody be well, and thank you again. Take care.
All right. Take care, everybody.
thank you, Jason. Thank you, John. I'm going to stay on just a few minutes just in case there's any questions regarding if there's issues with your name or registering for CE. Please make sure you click the link at the top of the banner.